Hello, my name is Andy Ho. I'm the CIO of VinaCapital. Today, my colleagues and I will discuss Vietnam and its current economic state and capital market activities. With me will be Mike Coccolari, our Chief Economist, and Ismail Pili, our Head of Research. Mike will discuss the current economic activities of Vietnam, and Ismail will discuss the capital markets of Vietnam. Briefly, VinaCapital is one of the largest asset management company in Vietnam with over $3 billion under management. We invest in assets such as the largest steel company in Vietnam, HPG, the largest milk company, Vinamilk, and two of the largest integrated resorts in Vietnam. We have also plenty of strategic exits over the years, including the sales of the largest vodka company to Diageo, the international school to Cognita, and the Hoàng My Hospital System to Fortress Healthcare and the Chandler Group. We manage assets across multiple asset classes, including open-ended funds, venture funds, private equity, and energy and fixed income. With that, I will turn this over to Mike. I will then come back and share with you the PE and private equity and venture investment activity and opportunities in Vietnam during this COVID and post-COVID period in the coming months. Mike?
So Vietnam has taken a big hit from COVID. That having been said, we still grew by almost 2% in the first half of the year. The biggest hit to the economy was from a plunge in tourist arrivals. Foreign tourists contribute about 8% of the economy. We also had a big slowdown in manufacturing. That having been said, manufacture of items that people need to stay at home, like electronics, has actually surged in Vietnam, which is good news. The consensus for this year is that the economy will grow by about 3%. One of the things that's helping to drive that consensus is that we've really seen a real strong V-shaped recovery in domestic economy. If you look at things like Google mobility data, you'd see that the local economy is basically back to normal. The other thing that's really been a positive is that we had an almost 5% of GDP trade surplus in the first half of the year, and that's driven again by the production and export of electronics. As a result, exports have been almost flat in the first half of this year, which is a much better performance than some of our regional peers. That's helped support the Vietnam Dong exchange rate, which is essentially unchanged on the year. Another real good piece of news is that inflation in Vietnam is very modest. It's likely to stay modest next year as well. But the real fabulous news that I want to bring your attention to is that although the COVID is clearly a very terrible human condition in the world, we don't take away from that, Vietnam is going to be one of the countries that really prospers the most after all the medical issues subside. And the reason why is that about 20% of the factories in China are going to relocate out of the country. We know this from industry sources. UBS put out a report about this a couple weeks ago. We also know that almost 3/4 of the manufacturers in China are either planning to leave or they're actually leaving. And there's been some surveys by Standard Chartered and others about this. As far as Vietnam is concerned, this is the most preferred destination for those factories to come. A lot of surveys from people like the American Chamber of Commerce and others. And that's not surprising that Vietnam is the most preferred location, given how well we handled the COVID crisis. The really good news, though, is that this next wave of FDI to the country is going to have a real transformational impact on the economy. In the past, when factories came here, they wanted to take advantage of the high-quality, low-wage workforce, and that will still be something that draws FDI factories here. But what we're going to see going forward is that FDI companies are going to make an effort to help build out the local supply chains. And the first example of that is Apple, which is going to make its new earphone studio product here. They'll manufacture the product in Vietnam before having perfected production in China first. And according to Apple, the reason they're doing this is because they want to help build out the local supply chain. So this is going to be hugely transformative for the economy going forward. That having been said, one obvious risk is that if 20% of the factories are going to leave China, there's only so much of that we can absorb here. So we think that Vietnam can absorb perhaps 3 to 4% of those factories before we'll really start to have the infrastructure and other issues will start to be overwhelmed. So overall, the long-term picture continues to be very fabulous. And I want to turn it over now to Ismail, our head of research, who can talk more about what's going on in the stock market.
As far as the market is concerned, the first half was unprecedented. We've seen bouts of volatility where the market fell by about 30+% in the first quarter, followed by another 30% rise in the second quarter. It's probably not realistic to expect the same type of bouts of volatility in the second half this year. And in that regard, we do think that it will trade at a much narrower trading band. Having said that, we do think that we will be beholden to two global factors, which includes the second wave concerns of the coronavirus, the extent of the global economic outlook, as well as their state of recovery. The third point is geopolitical noise, whether we think that things such as Black Lives Matters, Hong Kong unrest, or of course the US presidential elections will have a much bigger bearing than we expected. And finally, we have to be acknowledging the central banks, not just the Fed, but the global central banks releasing tons of liquidity as far as QE is concerned. In terms of the market itself, maybe I would just leave you with a couple of numbers to highlight the appeal of Vietnam. First, in terms of the EPS growth outlook, or in this case, contraction, Vietnam is expected to see an 11% contraction. In comparison, ASEAN is expecting to see a deeper minus 21%. And on valuations, the PE of Vietnam at 15 times looks much better than ASEAN's 18 times. Thematically speaking, we are looking at about three things here. The acronym here could be DIE, Defensibles, Infrastructure, and Early Domestic Recovery Plays. But for the most part, we do think that this is how we want to focus our investments. Defensibles just means companies that are very, very solid in terms of their earnings outlook as well as balance sheet. The infrastructure is, of course, an easy lever for every government to be pulling when times are bad in terms of economic growth. And finally, the early domestic recovery plays. Vietnam has done a fantastic job in terms of addressing the COVID situation, and we have seen reopenings and hopefully the path to recovery as far as businesses and economy is concerned.
Thank you, Mike. Ismail. So as you can see, Vietnam's economy is quite stable at the moment. We have a growing GDP. You have inflation that's low and interest rates that's coming down. And what's great about Vietnam at the moment is the local currency is quite stable and even appreciating against the US dollars. That presents a situation where we have companies that are servicing the domestic market that has strong cash flow. We have food and beverage businesses, real estate businesses that are doing very, very well, servicing the domestic market. So what are the opportunities for us to look at when it comes to PE investments and venture capital? By and large, we are looking at companies that are top players in their respective sector. There are sectors that are interesting, revolves around consumer-oriented sectors. So in the private equity side, we are seeing healthcare, hospitals, we're seeing financial services, the banking sector, real estate, and its peripheral industries to support. For example, right now, real estate is a strong market where if developers building an apartment or townhouses, they're able to sell it quite easily. So it pulls the supporting industries from materials to financing to construction services along with its real estate development projects. So there's a lot of opportunities at the moment that we're seeing. When it comes to private equity and venture investment, the key area we focus on is terms. What are the terms that we can enter in today? From a valuation perspective, unfortunately, it hasn't come down significantly. The primary reason is because the stock market has, as you've seen earlier, shown a V-shaped recovery, and the sponsors have simply said, look, we're still keeping the valuations at a pre-COVID level. In terms of commitment, they are stepping up to the commitments. We usually ask for 2 to 3 years of growth commitments, whether it's EBITDA or profit growth. And we do get our usual rights and warranties, such as veto rights. We have about 20-something veto rights, and the ability to sit on boards, participate at the managerial level. With all that said and done, we are approaching private equity and venture investment for that matter as a growth capital. We are not taking control stakes in businesses and doing MBOs or management buyouts or anything like that, simply because we find it's very, very difficult in this environment to bring in outside managers to run the business. Because once you buy out a business or take control of the business, you tend to have to bring in executives from outside to run businesses. They tend to be hard to find, very expensive, and demonstrate allergic reactions to the culture in the business. So we tend to stay away from buyouts and focus more on capital growth capital story for these businesses. We are also able to do due diligence quite easily now. We have the Big Four here to help us with the financials, legal, and we also do ESG due diligence on all of our opportunities to invest in. But we are seeing a lower level of competition. As you can imagine, with the restrictive travel, we're seeing less and less capital coming in from other places from outside Vietnam. So primarily, the competition to do deals has dropped significantly, and it's really those that are on the ground that's able to access deals and do due diligence and discuss terms. From that perspective, it's more positive for us to do deals in Vietnam. So in summary, we have a lot of opportunities, great businesses that service the consumer sector. The terms, unfortunately, hasn't changed dramatically, but the competition to do these deals have dropped significantly. Okay. In terms of risks, obviously the cash flow is always a big risk, particularly in this environment. We are seeing businesses having a harder time projecting the cash flow, the revenue, the P&L for 2020 and even 2021. So it's going to take time over the next 2, 3, or 4 months. It's going to take time for them to understand how to project the performance of the businesses in the coming months and year. So that is a risk that we have to take on at the moment. The other risk is exit. Again, with restrictive travel, whatever you've invested in today, the ability to exit to strategic buyers tend to be limited because they aren't able to travel to Vietnam. Fortunately, we have a very robust and liquid stock market, so a lot of these businesses can go onto the stock market, and hopefully we can sell the shares in the stock market as an exit path to our investment. And as far as the return is concerned, we are looking at opportunities that deliver returns of 20% plus on an annual basis in V&D. That's the minimum that we are looking for. Typically, we get around 25 to 30% return. We do have significant downside protection in some of these businesses. And overall, we tend to deploy about $20 to $40 million in each of the investments and look for a return between 20 to 25%. With that, thank you very much for your time, and I'm here to answer any questions that you may have. Thank you.